Welcome to Market Radar. We're not investment advisors, security analysts, or brokers. The following information is strictly for entertainment and educational purposes only. None of the information here is intended as a buy or sell recommendation. Hey everyone, it's April 24th, 2022. My name is Artie. I'm here with Gamma. Welcome to another Radar Report podcast. Let's get started with the year-to-date performances. The S&P is down 10.3%, NASDAQ down 18.21%, Russell down 13.38%, and Dow Jones down 6.89%. So we had quite a bit of a gonging in the last week. The ES trend switched to bearish from neutral. We're back into bearish territory. And as you know, that usually means we will see lower lows coming up. We've got stagflationary odds slightly increasing again, as well as deflationary odds. System strength did increase from last week. System is more confident in the stagflationary regime that we're currently in. We have a total of 68% chance of a risk-off situation, which, we already knew that. We've been saying that for quite a while now. We are definitely in risk-off, as you can see from the last week. Let's move on to the economic calendar. Monday, we've got no market-moving events. Tuesday, we have durable goods orders, Case-Shiller home price index, consumer confidence, and new home sales. Wednesday, we've got international trade in goods, EIA petroleum status report. Thursday, we've got GDP, jobless claims, EIA natural gas report, and Fed balance sheet. Curious to see what that's going to look like. Friday, we've got personal income and outlays, employment cost index, Chicago PMI, and consumer sentiment. And keep in mind, next week, we've got a ton of earnings coming up. We've got all of FANG reporting except for Netflix. I'm not going to name all the names, but we've got a lot of earnings next week. So keep an eye on that. We'll see how that affects the market. See if we'll continue downward or if we'll get a reversal. Let's look at ES. As you can see, we got two fat red candles Thursday and Friday. It goes along with what we've been saying. We're going to be going choppy and down, which is how our portfolio has been positioned. This is risk off. There's really no reason to be long equities since January. It's gone nowhere. That's why we've been advocating for cash over the last few months. Let's take a look at ZN. ZN's continuing downward. We don't expect this to slow down. Everyone's trying to catch the falling knife. It's just not going to happen. As we've been saying for a while now, with real yields going positive, we did touch zero territory, but we don't think we're stopping at zero. We're going to be going into positive territory, and that's going to bring ZN much farther down. So anyone trying to long it right now, probably going to get ass raped. Not the ideal play right now. We might see maybe a short-term relief rally, but it's not the play to be in right now. So today we kind of want to talk about bare bones, what everything is going on, what the play is, and what we foresee happening. So let's just get into that. Gamma, you want to get us started? I think you might be muted.
Oh, I'm sorry. Yeah, I'm here. So let's take a look and let's start talking about what we've been harping about for the last 2 to 3 weeks, which is high yield. So it's important when we look at high yield, specifically the ETFs that we can all see and track, that we adjust them for dividends, because the only purpose of buying high yields, or the main purpose, is to accumulate the dividend. So if we adjust the high yield performance for dividends, you'll see that on Friday we broke the yearly lows that were put in March 14th. Now, what's significant about March 14th? Well, you know that on March 14th and after, preceding March 14th, 15th and after, the market as a whole bottomed and continued higher. This was when the Fed came out after March 14th. I think it was the 16th, the Fed came out. The market kind of rallied ever since. We are now back under those lows. And we've spoken about this in depth multiple times on why high yield is an important component when tracking risk. So high yield breaking the lows on a dividend adjusted basis is very bearish for equities. And I think that the fact we took out the lows on Friday, the market started to pick up on that and started to puke. And if we go to TIPS, which are Treasury Inflation Protection, you can see here that we had a little bit of a pop after going positive, and we'll go over the real yields in a second. But we basically fell from negative territory. Remember, TIPS are basically inverted real yields. So if TIPS fall, real yields rise. Around here, around 120 on TIP was positive territory in the 10-year, and it bounced up. Now we're sitting right under positive territory, and it looks like this on the actual real yields, where we're bouncing off zero. We're right under there. And this goes back to what you said earlier, Artie, about bonds not being the buy. We have been saying this religiously, and we've
basically since the start of the year. We
yes,
called the entire rally, and now people are
yes,
talking about real yields.
yes. We basically said that bonds will not be a buy until real yields peak. Now, if you look at the chart that I have up, you'll notice that real yields did peak pretty much at zero. Intraday they traded a bit higher, but on a end of day basis, they peaked roughly at zero. Now, that's not the peak in real yields. This is not the like what we've been talking about. Oh, when real yields peak, we'll buy bonds. We think that real yields are going to peak decently, or I should say, pretty deep in positive territory. Like not zero, not 10 basis points, higher. How high? We don't know yet, but that just goes to show you that bonds, in our opinion, are not the buy right now. As long as we're in negative real yield territory, we are not buying bonds. Why? Because we can go over, we have record inflation, we have mismanagement by our central bankers. We have all this nonsense that's going around that's clouding the problem, that the 60-40 doesn't work anymore. What's the 60-40, right? That's the idea that 60% equities and 40% bonds.
Yeah. Anyone holding
Right?
a 60-40 portfolio right now is probably in the worst position that you can be in.
Yeah, if I had the terminal open, we could pull up the historical performance of the 60-40. I don't have it open right now, but we literally could track, and I think we'll put up a chart later on Twitter, the history of the 60-40, but it's terrible. And I guess a quick way to look at it would be to go to would be to go to ZN, which are 10-year T notes, and they're basically falling off a cliff. And then we pull up ES, which has gone nowhere but down. We're down roughly 10% year to date. So there's no protection. You're getting gonged on what's supposed to be diversification. Now, why is that? Well, that comes back to number one, negative real yields, and number two, the Fed being behind the curve. We had negative real yields. Our first where real yields settled negative after COVID was pretty much in April. Like we had this fall into COVID, this pop, and then this settling back down. And that was April of 2020. Ever since April of 2020, the bond trade has been off. Pretty much.
Yep. So
right?
let's talk about what should people do. So where can you allocate money? Because I see people saying stagflation is coming, obviously because they're behind the curve. We've been saying stagflation since April of last year. But people are saying stagflation is coming. Ideally, you want to be long treasuries and commodities. That's what everyone's saying.
So I think the way to answer that is you have to take a look at real yields from the perspective of where are they moving. Um, once real yields went negative, the bond trades become more and more unfavorable, which means risk assets. See, the whole theory behind it is when real yields are negative, risk assets are in favor because bond assets are out of favor. If bonds are out of favor, risk assets are in favor, right?
Yeah,
That's the idea.
because money never disappears. It just
Right, right,
reallocates. So
right.
if
So
it can't reallocate to bonds because they're negative yielding, there's no reason to put money into bonds.
right,
Where else are they going to go? Equity.
right. And what you saw in 2020 in April, um, the bond trade was technically still on for a few months after. So from April and May 2020 all the way to like August 2020, the bond trade was still there because there was fear that we were going to go negative rates in America at some point. During this time, the fear was we could go negative rates. So people were like, well, if we're going to go negative rates, that means that unlocks the door for perpetually more and more negatives, meaning like negative 50 basis points is not that bad if we're negative at the Fed. You understand?
Yeah.
And that was pretty much dismissed. And after that whole jargon and nonsense cleared, the bonds peaked because who wants to bid negative debt? Now, let's go back to what you were talking about earlier with stagflation and commodities and whatnot. The commodities trade has been well and alive and has been flourishing. The problem that we're running into right now is that we are if we take a look at our regime chart on you can find this on our website at market-radar.com/regimes. We are what we call peak late cycle. Okay. Where FinTwit thinks we are, and where people that don't understand the landscape think we are, is late early cycle,
That's why they're
where they
trying to
think,
buy the dip.
right, they're buying the dip thinking, um, and there's a lot of reasons why, and it's not really like they get it, but they don't get it. They look at GDP and they say, well, GDP is still technically positive. We're not. And remember that we went over this a few weeks ago, or I think it was a month ago in the podcast, where GDP contracting is equal to a recession, right? 2 consecutive quarters,
Yep.
but in reality, the market's already front running that. So people are seeing GDP as positive, and they're basically saying, well, oh, we're not late cycle. GDP is accelerating/rising. So we're early, we're early rising. We're not late stage falling or peaking. We're early bottoming, not late peaking, is what they're saying. Now, if you understand, those terms are basically, think of the cycle as you can see if you're watching the video as a sine curve. Okay. And late stage peak is the top of the curve where you start to peak over the roller coaster and you start to go down. Which is the roller coaster effect. We spoke about that in the I think it was podcast number 5 or 6. And then the bottoming phase is where you stop the downturn and you rise back up again, the bottom of the sine curve. So FinTwit thinks we are bottoming and rising, where we're peaking and actually falling. We haven't fallen yet. And the main reason why the market hasn't been able to price in this deflationary regime is because of real yields. Deflation is a horde of, bonds, gold, complete risk off. Like we talk about right now being risk off. Deflation is the true definition where cash is everything gets smoked. It's in deflation, you want to hold the things that get smoked the least if you're invested. That's how bad deflation is. It's not like, oh, we have this huge outperformer here. If it in the equity space, like things are marginally positive. It's not like you're record breaking in like an inflationary regime where commodities, financials, or anything else are really outperforming. Like you're just trying to get by in deflation. Now, we have tactics to leverage up the things that really do excel, but they're not really going to be equities. It's going to be bonds, gold, things like that, which aren't in favor yet because there's no reason to bid them. So
Yeah.
the market, from a pricing perspective, can't really price in deflation because we still have a huge amount of duration. Well, I guess half the durations if you measure the tips, the fives, the tens, the 20s, and the 30s. The fives and the tens are still negative. The 20s and the 30s are positive. But if you look at the average of real yields, we're not very far in the positive. So it's very hard to get a general bid on debt when half of it is negative yielding.
Yeah.
Half of the durations, I
So
should say.
essentially, we're not going to see a real sell off, a real risk off sell off until there's a reason for people to allocate their money towards bonds and take them out of stocks. That's why we're
Right.
not seeing stocks selling off. Where else are people going to put their money? People have to
Right.
put their money somewhere. You can't just be a fund managing billions of dollars and talking to your clients and being like, yeah, we're going to hold cash. They
Yeah.
don't do that. You can't do that as a fund.
Yeah. I've been around these things a long time, and I know that right now fund managers are getting from experience and knowledge. Fund managers are not boding well. They are suffering right now because there becomes a scenario where people go, this is the first time in a long time where you can go into a stock like KMB, Kimberly Clark, right? It's it's down 3% year to date. They say, why don't I own KMB? Why do I own a Netflix or a Facebook? Why don't I own Kimberly Clark? And you might say, well, realistically, Kimberly Clark might be a great company over the long term, but this, like, we're pretty much at the we're not even at the 2020 peak on Kimberly Clark, but they'll tell you why do we not own Kimberly Clark from a single perspective, from a single investor perspective. In a bigger fund where there's more like risk segregation, it's a bit different. But if you're talking about an individual that looks at their account and they may say like, why don't I own KMB? It pays a 3.35% dividend, right? It's only down 3% year to date. Why don't I own this? And you are now in a position where you're forced to rebalance out of the things like a Facebook, right? Like Facebook looks terrible. God bless the Facebook shareholders, really, right? Like it looks terrible. It's down 45% year to date,
Jesus.
right? Like the funds that own, and go back to 2020. If the peak in 2020 was, let's look at the peak of 2020 was here at 307, we were almost at 400 in 2021 or late 2021. So there was some decent growth here in Facebook, right? But it all fell apart. And this isn't the only company. There's things, we can look at companies like Square, right? We can look at companies like PayPal. These are all like, this is terrible. PayPal, we're talking PayPal is down 54% year to date.
Yeah. So definitely not the place to be. And like we've been saying, we've got high allocation in cash. That's what you got to do during stagflation because
Right.
you're not going to get the market falling apart because, we can't get deflation until there's a reason to buy bonds. So
Right.
you can't just short stocks and buy puts and all that because it could take a while, we could be in this for a few more months until real yields go up to a point where there's a reason for people to pull money out of stocks, collapse the stock market, and put money into bonds. And that's essentially what we're waiting for. We're waiting for that inflection point, and we're not going to front run our model, but our model will tell us when to buy bonds. And that's what we're anticipating the next play will be. So,
Right.
long
And
story short, is just cash right now and then balls to the wall on bonds when it's time to buy them.
right. And I think a good way to look at this is like PayPal, right? So there was decent risk off signals going back into the summer of last year, but this is our like the regime chart that we use, the economic regime cycle, and we'll go back to PayPal in a second, is the key, or I should say, the lock, and DDAP is the key. So to get in, you need a lock and you need a key. Just with a key with no lock, you can't get into anything. You need the lock to put the key into, right? So Think of the economic regime cycles as the lock, where you know we're in a position and where the market as a cycle is going. Okay. Like we know in stagflation, credit quality is deteriorating, credit spreads are narrow and widening, and the opportunities risk off. Now, what credit spreads and credit quality are? Well, that's basically high yield, the spread between risk and safety. That can be a whole nother video, or I should say a podcast. What we're talking about right now is the cycle being the lock. So you know stagflation's here, you know risk is off. That's what you need to know. Risk is off. So now we go back to PayPal on DDAP. We know risk is off going into the end of the year. DDAP triggers bearish trend. Let's just say you were long PayPal for whatever reason, and you basically ignored the risk off signal on the lock. Now you have the DDAP being the key. You say, oh, well, no matter what, PayPal was bearish trend here. It went bearish trend on September 29th, 2021, way before their last two earnings releases. It was closed at 259, currently trading $86. So you say, okay, no matter what, DDAP's telling me something. If I want to believe in the regime cycle or not, DDAP is telling me that it is not a time to own PayPal, right? Okay, so what does that mean? I get out of PayPal. So the problem is you're now in cash. You sold your PayPal, right? And you're not sure where to put the money, but you're not in PayPal. At least you're not taking the ride down to 80. The problem is you have this cash building up right now. We don't have a deflationary pivot. Okay. So people are not sure what to do with their money. And this is, remember, it's not people what are looking at our models are saying, it's people in general. There's a lot of people that, or I should say more institutions and funds that sold PayPal north of, 250. They're not the big funds though. The big funds all own PayPal. All these big funds are taking the ride down in a lot of these stocks, but the smart people, which are usually not the most famous, don't own PayPal right now. Well, what do they own? This is the key. They own cash, and this goes back to us saying that the rise in the dollar index has been rather aggressive ever since the risk off pivot late June 2021. The dollar has been pretty much going straight up, signaling that risk is not, there's no gasket right now. You can't dump money into bonds. Gold is unfavorable because of the fact of real yields. Like if you're not going to buy bonds, you're not going to buy gold. You understand that? Like if we take a quick look right here on, let's take off DDAP and let's type in TLT. Look, this is the chart of TLT, and let's go out on a 5-year chart. You know what? Let's go out. Yeah, 5 years. This is TLT. Let's overlay gold, GLD, on a new price scale. You can see they pretty much move in synchronous, except the last, I'd say, 4 or 5 months. So people understand that there's a very strong correlation between bonds and gold, especially long-term bonds and gold. So the smart money is not going to buy gold because this is diverging and it's going to eventually correct. So it's like, why would I want to own gold if gold is going to come down? Now, it could be the case where there's an arbitrage where gold falls and bonds rise. Regardless, owning two at the same time doesn't make sense. So there's really it's hard for money to leave the market. There's no real gasket, if that makes sense.
Yeah. And so that's why we've been saying cash is king right now.
Right.
You just got to hold cash and wait it out.
Yeah. And if we go back to our economic regime cycle, if you're wondering how to look at this, like I said earlier, the economic regime cycle is the lock. Look at this. Get an understanding of what is going on. Say, our regime matrix, our system regime matrix is telling you that it's stagflation. So based off of what has happened in the past with the back tests down here, what is going to happen or more likely to happen. Obviously, historical results are not indicative of future performance, but you get the idea that on average, these things should, quote unquote, should happen if this regime is present, right? So if we know that we are late stage on the cycle peaking, okay, aka stagflation, then you know that growth is going to peak and CPI eventually is going to peak, but it's not peaking yet. So growth names are out of the question. Going back to, the PayPals, the Facebooks, right? the Netflixes. Oh, look at all these things getting absolutely smoked. Even Google on Friday. Google had the sell on DDAP back in January, mid-January. You know, we're approaching 20. We just closed on the 2400s on Friday. So this goes back to us not being in growth. Why? Because it's not the right time. Now, if you take any stock that we don't cover, you know, let's just say, for example, we take I'll type in a random ticker, AXP. The first thing that comes to mind, American Express, right? This is a financial. This is a financial company. Okay, it's currently up 10% year to date. Okay, does that mean I'm gonna own this right now, even though it's bullish on DDAP, bullish trend?
No,
No,
it's
right.
that's why we have criteria. You
Which
can
is
never
our
rely on
right.
one strategy.
And this goes back to the lock and key example. You could have the best looking trend, the key, right? For we'll call it American Express, bullish trend, but it doesn't fit in the lock. So like it's the wrong key. So like there really is no point of doing it because you know American Express could fall apart all in a day, in 2 days. I mean, you know, this thing can really shit the bed if it wants to. So why are we going to belong it right now? We're not. That's the whole point. If we were early stage bottoming, it'd be a different story. You know, early stage bottoming, or we're in mid inflation, and there's a reason why we think financial companies are going to do well in the economic landscape, which is usually during these two regimes. We would own quote unquote risk assets or AXP. For example, as you can see here, out of COVID, they didn't break the COVID highs until March of 2021.
Yeah.
So
So
this is
I think, I think we covered. I think we covered a good amount of what needs to, like, what the ideal allocation is. Actually,
right.
something I do want to talk about as well is I see people saying long commodities now because stagflation is coming after 100% ripper in crude oil, corn, natural gas. Now people are saying to go long it.
Right. Well, let's pull up commodities while
That
you
could
talk
be
about this.
actually a good short opportunity. If we're
Right.
seeing stagflation topping and deflation coming next, commodities get absolutely destroyed during deflation. So it could be a short opportunity coming up in commodities as well.
Now, I think you made a good point there about the commodities. You have to pay attention to where you are. Let's go back to this the cycle. Typically, stagflation doesn't last the duration to the extent it's been we have it. Typically, stagflation is a predecessor to deflation, or I should say, excuse me, a warning sign of deflation, of oncoming deflation. So, and it's usually rather short. So, stagflation is the yellow flashing light on the on the street that's like, okay, we're about to go to deflation. It's basically the warning sign. So most of the time you don't actually want to own commodities in stagflation because they tend to you tend to be getting the pivot to risk. You're in risk off pivot going further. So it's like, okay, you're peaking, not the best time. You'd rather own those commodities in the risk on areas where everything's growing. Or specifically, specifically you want to own commodities in inflation. That's really where they do the best. Now they've done decently in stagflation, but that's because we've had this sticky stagflation complex that hasn't been seen in so many years, where real yields are so negative that it's making it very hard to pivot to deflation. So the stagflation is really like sticking around, in the inflation component, right, where there's CPI rising, is continuing. So commodities are still doing well. And this goes back to what you said earlier, that there could be a pivot, right, in commodities. Well, I'll just scroll back on commodities and I'll show you what those pivot, like what could happen. Like rather quickly, I should say the shit can hit the fan,
Oh, yeah.
right? So being long, we had this dip buying opportunity in commodities back in March. I think it was a day before Powell came out and did the first hike, right? That was March 6th. That was here.
Yeah.
So,
And we were
uh,
debating on buying the dip.
yeah, we were debating about getting some commodities exposure. Now, granted, if we did, let's do some quick. Even if we take the high from the day after, it'd be a 8% gain right now, 8 to 9% gain. But the problem that you're running into is you're fighting the Fed being long commodities. Now, this is where like a little bit of nuance is required because the Fed is going to be aggressive with their hiking procedures. So the Fed inadvertently is going to take real yields. They're basically going to fix this problem for us where real yields are negative. They're going to hike aggressively and basically try and kill break evens, which remember, real yields are nominals. The current 10-year, where we have right here, the current 10-year closed at 2.9, and the break evens, which if we type in, this is where the forecasted inflation rate is over the next 10 years on a yearly basis, is 2.98%. What they're going to do is they're going to try and hike rates, kill break evens, and they're basically going to widen, right? They're going to increase the real yield. They're going to widen the spread between nominals and break evens, aka increasing real yields. They're basically going to set this up for a deflationary event if that's where the market wants to go. Listen, we could go peak cycle so long that like the trough of this, or I should say the downturn of the next I should say cliff here in deflation is rather mild. They could do that too, where we're stuck in a stagflation for many more months. But I'm thinking, this is my personal opinion. The Fed is trying to basically revert real yields and make bonds favorable again.
They
And
they
they know,
essentially want to force deflation.
yeah, yeah, and they know that real yields need to be positive for there to be deflation, which is why they're being so aggressive with their hiking procedure. They know that by hiking, they're going to push the nominals up and they're going to kill break evens. So this goes back to our commodities play, right? Why are we going to be long commodities if we know real yields are going to excel higher and they're going to force a deflationary event? They're going to try and kill inflation, which I should say CPI, right? That's what we should, because inflation is one of our regimes. They're going to try and kill CPI. So they're going to try and put us into deflation, which is the worst for commodities. So that's why we don't have a commodities position. We'd rather hold cash and wait for the bottoming to early stage, right? Early stage bottom to buy back in, or more precisely, inflation to get long again.
Yeah, exactly. And
Right.
that's basically it. That's our thought process.
And I think we'll definitely go over some more in-depth topics in the next podcast. But we wanted to take this podcast as an overview, given that last week there was complete carnage into the end of the week, and we've seen a lot of people on Twitter saying that they are going long the dip, that the all-time highs are coming, which I don't know where that thesis is derived from. But I think it comes back to this, that consensus positioning has been a moneymaker for everyone for many years, where they literally can say everyone's bearish, so I'm bullish, right? Like everyone's so bearish right now that they're overly bearish. To end this podcast off, if you were alive, if you were old enough during the 2008, 2009 financial crisis, the great financial crisis, you should either ask yourself or ask those around you, how bearish was everyone? Now, I'm not saying we're going to have a financial crisis, but that's the whole point of where they say consensus is, too bearish. I promise you that in 2008, 2009, you ask anyone, there was no overly bearish. There was, I don't know if the stock market's going to be around anymore. Like there was no like, oh my God, we're overly bearish. Like we're bullish now. You understand? There
Yeah.
was complete loss of confidence in the entire financial system. So when someone tells you that there is no confidence, that they're overly bearish, so that you have to be bullish. Now, it doesn't mean we can't bounce here, any of that nonsense, chop around. What the simplicity of what I'm trying to tell you is that the Fed the Fed was backing the idea that if you're overly bearish, you're fighting the Fed, so you have to be bullish. You understand? But we're in a position right now where the Fed is no longer bullish. So if you're bullish to the extremes, you're fighting the Fed. Don't fight the
That's
Fed.
rule number one. Don't
Don't
fight
fight.
the Fed.
They have more money than you. Actually, they don't have more money. They have the ability to print more money than you. Okay. They have more power than you do because they can control more things than you can control. And ultimately, they are the ones that can stop and start economic cycles. They inadvertently think they know. So let me clarify that. They unintentionally start and stop economic cycles.
Yeah, they don't know what the fuck they're doing.
Yeah, they don't know what they're doing, but they started this entire boom with this bullshit monetary policy.
Yeah.
Now, this has been going on since the great financial crisis, and it's been getting worse and worse and worse. But in 2020, they're coming out now saying they did too much. What I mean to say is they can shift the environment rather quickly, but most of the time, unfortunately, the shifts are happening without them understanding what they're doing. So it's, they're shifting it unintentionally, but they are shifting it, if that makes sense.
Yep.
So just keep an eye out on the market in the next week and a half here. We'll see what's going on. I think May 5th or May 6th, we have an FOMC meeting. We'll go over that and another topic more in depth next week in the next podcast. But we just wanted to make sure that everyone's on the same page here and understands what we're looking at, what we're processing, and more importantly, why we say and do the things that we do. It's not out of us just wanting to make a grand call or be right or try and play Michael Burry, because in reality, that's all meaningless if you get it wrong. Like we're here looking. We have a model, tells us to jump, we say how high, tells us to duck, we say how low. It's really that simple. And I think that's where we should leave it off this week.
Yeah. Thanks for listening.